The stock market's at an all-time high, oil prices are up 60%, and bond yields hit their highest levels. One of those is wrong. That is a massive glaring contradiction staring every single investor right in the face today. Renowned tech hedge fund manager Dan Niles said this, and honestly, it perfectly sets the stage for what we are digging into today.
Welcome to This Explainer. Today, we're going to decode a huge market disconnect. We are looking at a financial landscape where the most reliable traditional economic warning signs are literally flashing bright red, and yet the stock market just keeps soaring to record highs. And sitting right at the center of this whole shebang, the artificial intelligence boom. A boom that Niles predicts could actually be heading for a 30 to 50% crash by 2027. We're going to break down exactly why.
Okay, let's dive into this. Here is our roadmap. We're going to cover the current market paradox, the agentic AI boom, the predicted 30 to 50% AI crash, the threats of high oil and bond yields, and finally, the case for holding cash.
Section 1. The current market paradox.
Let's really frame the mystery of this current market paradox. We've got a soaring stock market that seems totally disconnected from some glaring macroeconomic warning signs. Just look at this number. Oil prices spiked by a massive 60% this year, pushing right up into the mid-90s before settling back just a little bit. Historically speaking, this kind of energy shock acts as a massive tax on the consumer, and it slows down the entire economy.
And then we have this, a 5% guaranteed yield on 30-year Treasury bonds. The bond market is handing investors some of the highest risk-free returns we've seen in years, which is a massive signal of incredibly tight monetary conditions.
And yet, despite those massive macro pressures, expensive oil completely draining consumer wallets, and high yields offering super safe alternatives, the stock market just continues to sit at absolute record highs. The market is effectively ignoring these traditional economic threats. So why? What is so powerful that it's overriding the basic laws of financial gravity?
Section 2. The agentic AI boom. The real catalyst behind these soaring stock prices is a fundamental shift in artificial intelligence. Look, we aren't just talking about basic chatbots anymore. We are entering a highly demanding new era. Look at the clear distinction here between the AI we all got used to last year and what is happening right now. Chat-based AI is pretty simple, right? You ask a question, it gives you a direct answer. But agentic AI? Oh, that is a whole different beast. With agentic AI, you give it a prompt and it actually acts as an autonomous agent. It might go over to the BBC website to pull data, jump over to Bloomberg or CNBC to cross-reference it, and then organize the whole thing into a formatted Excel spreadsheet for you. It's independently orchestrating multiple tasks.
Because it's doing all of that complex multi-step orchestration, agentic AI requires 10 to 100 times more computing tokens than a basic chat query. Think about the sheer scale of that for a second. It is an absolute step function change in the computing power needed. In fact, right after major agentic AI models launched earlier this year, AI token growth exploded from 20% to over 120% in just 2 months. This massive, unprecedented demand for compute is fundamentally what is driving tech valuations to the moon right now.
And this brilliantly illustrates the fallout. Look at the resulting capital expenditure, the infrastructure spending of the massive tech hyperscalers. At the start of the year, growth projections were sitting around 30%. Then, a few months later, they were revised to 60%. And recently, pushed all the way up to 70% growth. These companies are pouring unprecedented billions into hardware just to support this 10 to 100x leap in computing requirements.
Section 3. The 30 to 50% AI crash. Now, while that massive AI growth is undeniably spectacular, it's setting up a deeply precarious situation. It's time for the bearish reality check to decode exactly why Dan Niles is predicting a massive 30 to 50% crash in these tech sectors by 2027. The first major catalyst comes from looming trillion-dollar mega IPOs. We are very likely going to see absolute giants like OpenAI, SpaceX, and Anthropic enter the public markets in the near future, carrying astronomical valuations. Here is the mechanical problem with that. These aren't your average small-scale IPOs. When these trillion-dollar beasts hit the market, they are going to immediately become massive portions of the major stock indexes. But mutual fund managers aren't just sitting around on huge piles of excess cash. To buy into these massive new entrants and match the index weightings, they're going to have to drain liquidity from their existing portfolios. That means they'll literally be forced to sell off their current holdings in other tech stocks, triggering a downward cascade in prices.
And the cracks aren't just in market mechanics, they're actually forming inside the companies buying the AI too.
Enterprise IT budgets are not infinite, guys. Companies are currently funding their massive AI spend by slashing other vital software and operational budgets. Plus, there's incredibly heavy pressure from shareholders to show a real return on investment for all this AI spending. If these companies don't see massive, immediate financial returns on their AI implementation soon, well, that 70% capital expenditure growth we saw earlier, it's going to hit a brick wall.
Section 4. High oil and bond yields. Let's zoom out from tech for a second, because the tech sector doesn't exist in a vacuum, right? We need to return to those macroeconomic threats putting intense pressure on the entire financial system. So the crucial point is this historical reality. 10 out of the last 12 economic recessions were preceded by a sustained spike in oil prices. High oil basically saps consumer spending power. It acts like a universal tax, and we're already seeing the stress. Major global indicators like McDonald's are reporting missed sales targets because their low-end consumers are simply running out of cash. If oil stays high for 1 or 2 quarters, it seeps into inflation and fundamentally damages corporate earnings across the board. Then you really have to ask this critical question. If you are an investor looking at a stock market that might be facing an AI reality check and an oil-driven recession, why risk your money in volatile equities when you can lock in a guaranteed 5% return for the next 30 years in the bond market? The higher bond yields go, the less attractive those incredibly expensive, risky tech stocks become to cautious investors.
Section 5. The case for holding cash.
With the market pulling in 2 extreme directions, AI exuberance on one side and severe macro risks on the other, we absolutely need an actionable takeaway. How exactly should you navigate a market where unprecedented technological growth and harsh economic reality are on a literal collision course, when one of these massive asset classes, stocks, bonds, or oil, is definitively priced wrong?
The answer from the source material is really clear. You should be sitting with a lot of cash, being nimble. It is a specific defensive strategy of holding much higher than normal cash reserves. Look, in a market where a random geopolitical event or a single disappointing earnings report from an AI giant could trigger a massive repricing, having cash allows you to protect your portfolio from the downside, and more importantly, it gives you the flexibility to buy back in when valuations actually make sense.
And it's not just a niche hedge fund strategy either. Legendary long-term investors are echoing this exact sentiment. Look at Warren Buffett. His company is currently sitting on absolute record levels of cash. The greatest investors in the world are looking at these long-term metrics, seeing that current stock valuations just don't align with the macroeconomic reality, and they are choosing to raise cash rather than buy into the irrationality.
Which leaves us with this final provocative thought. As Dan Niles points out, we might be in a year very similar to 1998. Back then, despite currency crises and bond defaults, the sheer momentum of the early internet build-out pushed the market up another 20 to 30% before the massive crash eventually hit a few years later. We are only in year 3 or 4 of the AI build-out right now. The momentum is fiercely to the upside in the short term, but the question you have to ask yourself is this. In a market completely ignoring 60% oil spikes and 5% yields, how long can the irrationality last before the ultimate AI reality check? Keep your eyes on the data, stay nimble, and we'll see you in the next explainer.